Welcome to today's roundtable discussion on the Economic Stabilization Plan, which was announced by the Finance Minister yesterday in Parliament. My name is Gunasegaram. I'm Managing Editor of the Star. With me today we have three panelists. On my left is Tan Sri Datuk Raymond Nawaratnam, who is the Group Corporate Advisor and Deputy Chairman of Sunway College. Tan Sri Nawaratnam used to be also working in government before in various departments, and he has spent quite a bit of time at the Finance Ministry, and I'm sure he'll have some good insights to share. Our next guest is Dr. Ye Kim Leng, who's the Group Chief Economist of RAM Holdings. RAM is the rating agency. They rate government bonds, for instance, and so he follows the economy here quite closely. Our third guest is Johan Tazrin Ngo, who is Executive Director and Chief Investment Officer of Amara Investments. Johan has worked as an analyst and as a fund manager before, and he will have something to say about how the stabilization plan will impact the stock markets. Let me just begin by quickly summarizing some of the points in the economic stabilization plan. The key ones, as I see it, essentially 7 billion which is saved from the reduction in fuel subsidies as a result of the drop in the oil price. This 7 billion which is saved is being channeled into other areas such as housing, infrastructure, public transport, maintenance, and so on. So that seems to be sort of the crucial plan that the government is pushing. The other important thing to remember is that there have been attempts to increase the disposable income by cutting the contributions to EPF from 11 to 8%. This is a voluntary cut, and it does not apply to everyone. And also, government servants have been given more time to repay their loans, both for housing as well as car loans, which for those who want will put more money in their pockets. And one key thing that has happened, one new thing, is that the government is now for the first time thinking in terms of selling its land through open tenders. I think one of the places which have been identified is the Rubber Research Institution's Sungai Buloh research land. So let me start by asking Tan Sri Raymond Nawaratnam to give his take on the overall stabilization plan itself.
Thank you, Guna. I've been involved in budget preparation for many years. I think this is the first time you have got two major budgets in the same session. And I suppose it's justified and it's commendable given the very unusual circumstances. But as the Minister of Finance, the Deputy Prime Minister, Datuk Sri Najib pointed out, these are unusual times. You need unusual challenges to meet. And for that reason, I welcome the stabilization program, but would have thought that it could have been more assertive, more aggressive, and would really be more, would be deeper. You know? I mean, as you have said rightly, it's the savings that they're utilizing. But they could have gone beyond it to have a stronger impact.
So what you're saying is we should have more deficit spending. Perhaps are you saying that the government should be borrowing money to spend, for instance?
I would think so. I mean, if it is for good investment, why not? And this is an opportunity which I think the government could have taken to really make some major changes in policy, because it's more of the same thing, and from savings rather than from additional allocations.
All right. What do you think, Dr.
Okay. If we look at the current global economic scenario, I think it's quite likely that it's either a kind of V-shape or U-shaped form of a growth path for the global economy. I think what we are facing now is actually a big U kind of a global growth scenario for the global economy. And as we are speaking, I think
essentially you're saying that it will take some time for the recovery
to come. It's a big U, it's not a small U.
Okay.
It's a big U, a dip and prolonged kind of the
when you
risk
say
of a
prolonged,
global
how long are you
it could
talking
last
about?
easily 2 to 3 years. And what we are seeing here is that the G3 economies, namely the US, the EU countries, and then Japan, all three countries are currently in recession, in the sense that third quarter and fourth quarter of this year, they are already contracting. You see. So we are actually on the brink of a global major synchronized downturn, to the extent that what we are seeing now is not unusual, in the sense that most governments, including the Asian economies, are rolling out not just cutting interest rates, monetary stimulus, but more importantly is actually the fiscal stimulus. And to add on Tan Sri's points about fiscal spending, I think it's very necessary. Although the 7 billion fiscal stimulus will add to our estimate about 0.5 to 0.7 percentage points to growth next year, we also should be mindful that in the 2008 budget and 2009 budget, the allocation is already expansionary. That means we are already, the government spending has already been projected to increase to actually counter a slowdown in the external environment for this 2009-2008 budget. See. So what we are seeing here is just an additional boost. See. So I think it's important that that this kind of spending takes place quickly and they are implemented effectively, because what we are facing now is actually a serious global slowdown or a sharp downturn in the first half of next year.
Right. You are thinking in terms of a slowdown for 2 to 3 years.
Okay, that is a big, what they call a big U-shaped scenario. See.
Okay.
Of course, now the positive or more encouraging development is there has been a fairly strong coordination among all the governments in terms of fiscal loosening, and now we are all adopting together some kind of coordinated fiscal stimulus to stimulate the domestic economy. So that can help to offset. So as long as we can see a very strong coordination among all the major countries that are supporting the global economy now, I think we would likely avert a kind of big U, perhaps a big V kind of recovery for the global economy. So here again, we are looking at a very what they call a V for 2009, but of course, if all the efforts bear fruits, then 2010 will likely see a much more positive global economic environment for the rest of the world.
So do you anticipate 2009 to slip into recession for Malaysia, or under what conditions would that happen?
There is, I think now we have increased the risk from 30% to perhaps a 50% chance of 2 quarters some consecutive decline in our GDP. But nevertheless, I think as long as we can adopt this kind of proactive measures, but particularly to increase government spending, because the private sector, because of risk aversion, because of uncertainties, they are actually reducing the spending. You see. So I think the only party that's available to offset this kind of slowdown is actually the government.
Okay. So you would agree that you think that the move is good? Would you have wanted to see a greater amount of spending? Do you think that the government should have borrowed to spend, for instance?
Here I would take a different stance, in the sense that perhaps because of the already expansionary 2008 and 2009 budget, so we just need additional boost. So we do not need an overkill budget, in the sense that perhaps with all the global coordination of fiscal stimulus, we may see a faster recovery.
John, any
well, I mean, first of all, I'd like to concur with both Tan Sri and Dr. Ye. The 7 billion stimulus package, it is, I mean, you look at all the economic data, it all seems generally healthy. So to a large extent, this is a preemptive measure. And this is a measure which is generally taken by a lot of the central banks and governments around the world, from the US, Europe, as well as in Asia. In terms of size, Tan Sri is correct, 7 billion doesn't seem that much, just over $2 billion US, especially when you look at it relative to some of the other economic stimulus packages you've been hearing around, even Southeast Asia, for example. But I do agree with Dr. Ye that putting that into perspective of the whole budget in its entirety, as well as additional measures that has been announced even before the 7 billion yesterday. For example, the cut in fuel prices from 270 to 215. You are going to get, as already reported from the previous budget, a cut in income tax as well. You put all of this into perspective, generally, it does actually meaningfully add to private consumption for next year, which is 58% of GDP. When you're actually facing very difficult times and external headwinds and you have no idea where exports are going to go, they're already budgeting a contraction in exports, you do need the fiscal pump prime. Now, in terms of whether the government should borrow or not, okay, that is a big question. I suppose it is important for the government to spend, especially when times are tough and you're trying to fiscal pump prime, but at the same time, you do have to strike a balance between your government finances, i.e. your budget deficit, especially when the currency is no longer pegged at 380. Okay, the currency generally has been weakening against the US dollar, mainly because the US dollar has been stronger, but it has been reported that the central bank has needed to actually use some funds in order to stabilize the currency as well. There has been massive outflows of currency going out, the foreign liquidity going out, so you need to actually maintain a reasonable balance in order to ensure that you do have foreigner confidence in the currency as well. Okay, and that is very important. This is the big difference. Today, what is being done, even in terms of cutting EPF contributions, which is a way of cutting savings at this time, which is actually very prudent. A lot of these measures were actually done during the 2001-2002 recession, when we had the TMT bubble burst and also the SARS problem. And frankly, it worked then. It's likely to work again. Okay, but the difference between then and now is our currency was pegged before, is no longer pegged now. That's number one. Okay, number two, our budget deficit was actually much higher in those days, at about 5.5. Compared to that, that's forecasted this year. So there is considerable leeway. The other thing that's also different is interest rates were lower then, at 2.7 for the OPR compared to 3.5 now. There is some room for monetary easing should it be required, especially when inflation trends has shown moderation. And I think the concern is now shifted more to deflation rather than inflation.
Okay.